What's up, everybody? Welcome to Even I Can Trade. Merry Christmas, ho, 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 and all that. Today, I want to talk to you about credit spreads. And not just credit spreads, but building wealth using credit spreads. And not only that, I really want to bring you a Christmas gift, which is to show you how to build wealth with credit spreads. But let's say you're broke. Let's say you don't have $10,000. Let's say you don't have $5,000. Let's say you don't even have $1,000 to throw at the market, play around with, and all this good stuff. But I bet you can scratch up $500. And I want to show you a strategy that I came up with to allow you to start building your wealth using only $500. Now, number one, I want to tell you that no strategy is foolproof. Everything has disadvantages, including this one. This strategy is going to show you how to build wealth, but it does assume that you don't take any losses. And we know everybody's going to take losses every now and then. I couldn't build that into the spreadsheet because it's way too random, but I'm going to talk you through it anyway and what to do if you do have losses, how to handle losses and all of that good stuff. But I am going to show you if you can get this strategy mostly right, you will build wealth in a relatively short amount of time and in a pretty, I would say, conservative way, relatively speaking, when it comes to options. So the first thing before we can get into the strategy, number one is I need you to hit that like and subscribe button on the video to encourage me and help me to keep continuing to bring content like this to you. I am trying to build the channel from scratch. It's a very difficult task. So if you're watching this video, it tremendously helps me out if you would just hit that subscribe button right now and then hit the bell icon so when I do come out with new content, you can be notified. Now, let's talk about spreads and combos. First of all, for those of you who do not know, you can see on the screen here, I have an excerpt from my class teaching how to do spreads and vertical spreads, exactly what a spread looks like if you superimpose it against a stock chart. So the idea is that you are going to place a bet that the stock is not going to go where you place your trade at. So you're trying to play keep away. It's like that game Operation. You want the stock to go away or stay away from your position, and especially end away from your position. So in this example, you can see the green area with the green check mark. That is the area that we want the stock to stay in and go. We do not want the stock to go in the red areas. I know my picture's in the way, but basically you don't want that stock to go below a certain price, which is that red area is showing you. In this case, this is going to be an example of a put spread because put spreads want the stock to stay up above it. So you want the stock to start above it and stay above it for the most part. That's why we do all of our technical analysis and everything and try to figure out, okay, the stock is finished dropping or it's finished doing whatever it wants to do. Now we can go ahead and place a trade below that in hopes that the stock is finished going down for the day so that it can go the other direction and leave our trade alone. You can do the exact same thing the opposite way. If you feel like the stock is going to fall or stay down for the day, you can do a call vertical spread and sell a call vertical spread and do the same thing on the upside. So directionality is something that you can take advantage of on both sides. You don't have to wait for the stock always to go up. And if it's not going up, just sit on your hands. You can trade this every day because the stock is going to do one or the other. Your job is to figure out which one it's going to do to the best of your ability. So if you are able to do that, you're going to put up a certain amount of dollars. And if you're correct, you're going to earn a little bit of money on top of that bet to keep for yourself. If you're wrong and the stock ends up below your trade or above your trade, beyond your strike price, then you're going to lose all of the money that you put up. Okay. The golden goose here is your probabilities. It's all about playing the probabilities. So if you have a 90% chance that a stock is going to stay above a certain number, then you're playing that probability. You're not going to get paid a lot of that, a lot for taking on that bet because it's not a super risky bet, but you are going to get paid something. So that's what the game that we're playing with vertical spreads here. All right. So you're looking for high probability trades that are going to make a little bit every time. And we're looking to repeat that process over and over and over again every single day. Now, probability, that means that there's going to be that chance that the stock does something that is a low probability move. So that's what you have to look out for. But if you can get a handle on that, then you can provide a pretty decent income for yourself over time. So once you get a handle on that, I want to show you the strategy and what that looks like once you implement that strategy. So I have 3 different spreadsheets here. These spreadsheets are showing a daily trade pattern. Okay. So each one of these lines, each one of these rows represents 1 day of trading. On the left-hand column where it says trading money, that is the money that you are using and putting up at risk in the market that day. And you can see for this particular pattern, we're starting with $500, only $500. Okay. The second column where it says daily profit, that is the money that you're expected to make that particular day if you win. So in this case, in this particular spreadsheet, this is the most conservative spreadsheet. This is using a 4% daily profit number. That's pretty conservative when you're talking about doing vertical spreads. It doesn't matter if it's a put spread or a call spread or a combination of both, that your target is going to be $20 or 4% of the money that you put up. Okay. The excess profit column, that is going to be the accumulation of your profits as you make them over time, that eventually we're going to take out from our excess profits, and we're going to start adding that to our trading money. And I'll explain that as we go down. The growth column. The growth column actually represents how much you're going to grow your trading money by that particular day. Okay, so right at the top, you see it's nothing but zeros because we aren't growing our trading account yet. We're not growing the amount of contracts that we're doing yet. The contracts field shows how many contracts you're going to be able to trade based on how much trading money that you have. These are how many contracts that you're actually going to enter into the system to make all of this work. The savings column is how much money that you're pulling out of the market and setting it aside somewhere in a savings account or wherever. We're just pulling this out. We're not going to trade with it. This is ours to keep. This is our safety or whatever, but you're not going to trade with that money. You're pulling this money out as your income. Okay. The savings rate, this is going to be what percent of our profits that particular day that we're going to pull out of the market once we're complete with our trading. Okay, so right now we're at zeros, but you'll see that change as we go down, and I'll explain why. And then your total money, this is the total amount that you should have after you're complete trading that day. That's your trading money, that's your savings, your excess profit, everything all rolled up at one. And then your percent at risk, that is your total money that you're actually trading with right there. The percent of your total account value, that's your savings and everything. What percent of all your money are you trading with? Our task, our goal is to get that number down to like 10%. And you can see on the very first trade, we're starting with like 96% or something like that. It's really 100%, but it does factor in that we made $20. But our goal is to get that number down, especially once we get into the larger numbers. Okay. It's okay if we're only, with $500, $1,000 or something like that. that we're using a large amount of our total capital. But once we get up into, more figures, we don't want that. We don't want to have one bad day wipe us out. So our goal is to get that number down as far as we can get it, probably 10% or even less, as far as what we're trading with. Okay. So let's say that you are, I don't know if you can see my cursor or not, but let's say that we're starting with our first day. We just put $500 into our trading account. We're ready to go. The market opens up and we're looking and we spot a good trade. What we want to do is we want to target $20 profit. Okay. So that could be a put spread, that could be a call spread, it can be whatever. It can be a put spread, it could be two put spreads, it could be one for 10 cents and then one for later for 10 cents, or one put spread for 10 and one call spread for 10. Whatever combination, we want to walk away the day with 20 bucks in our pocket that we didn't have before. Okay. And that's usually pretty easy to do in most markets. So this is pretty conservative. I would say you're probably looking at maybe like a 5 delta, 6 delta, something like that type of trade. So usually like in the 90s as far as the percent probability that this trade is going to be successful. It's probably a trade that you're going to want to put on around 10 to 11 o'clock in the trading day, something like that. And you can usually pick up a lot of these types of trades. Now, like I said, every row is one day. So let's say our first day we're successful. We pocket our $20. We are left on the right-hand side on our total money number with $520. And we go to sleep, wake up, next day, do it again. Make another $20. Now you've got a total excess profit number of $40. That is $40 that we've made out of the market so far in our 2 days of trading. And we call it a day, go to sleep, wake up, do it again. Next day, we make another $20, add it to our profit, $60. So go to sleep, wake up, do it again, $80. Go to sleep, wake up, do it again. And we just keep stacking, don't do anything with the excess profit. Don't spend it, don't do anything, just keep it there. And we're going to keep it there, and we're going to do that until we get up to $500. This is going to be around day 25 that should happen for you. And again, I understand that there's going to be losses. So this is not saying that you're going to be successful 100% of the time. This is just saying when you get up to that number, this is how many successful days it should take you to get there. Okay. So sometimes you're going to have to take an L. Sometimes you're going to have to roll, whatever the case may be. Eventually you get to this number. It takes about 25 successful trading days to get there. Okay. Now, once you get your first $500 total profit right here, okay, what you're going to do with this particular plan is you're going to take that $500 and now you're going to add it to your trading money. So now instead of trading with $500, you are trading with $1,000. What that's going to do is that's going to allow you to trade with another contract. So instead of using one contract to trade with, you're now going to enter orders for two contracts or 1+1 or what have you, because your goal, instead of making $20 a day, now your goal is to make $40 per day with that $1,000. Split it up however you see fit, whatever works for you. And we're going to rinse and repeat. We're going to do the same thing. We're going to take that $40 and we are going to make it every day until we get another $500 right here, which should be around your 38th or 39th trading day, your successful trading days. Again, understand that there's going to be losses and setbacks in here. That's okay. So once you get that, we're going to dump that $500 back into our trading money. Now we're going to have $1,500 to trade with 3 contracts. And instead of making $40, we're now going to make $60 per day. Okay. And it's slowly starting to snowball at this point. If you're lucky to have all of these trades be successful, this should take about 2 months to get to this point. Okay. Sounds very slow, but you just wait. Okay. Buckle up. But at this point, we're making $60. We have $1,500 to trade with, and we're starting to get a little teeny tiny bit of momentum here. And we're getting a lot of experience. So this is good to actually start like this, because all up in these top parts, let's say you just don't have a lot of trading experience. Well, it's good to get that trading experience while you don't have a lot of money at risk, right? So you're really getting a lot of experience, seeing a lot of different markets. You've probably gone through at least one, if not two, Fed days at this point, with the interest rates and Chairman Powell and all that good stuff. A couple, you might even have crossed over an earnings season by this point, but you're getting a lot of experience that you're going to need once you start trading larger dollars, so you don't blow yourself up. Okay. But we're at $1,500. We're making $60 per day on our goal. Now, one thing I just thought of, the SPX, this is new for everybody that's traded for a while. You could trade the SPX 5 days a week. So if you're trading the SPX, this is literally every day. This is where I'm getting this from. This is either the SPX, or I think the Qs also trade 5 days a week. But trading the SPX, this is where this is coming from. The SPX trades 5 expirations per week. So you can really ramp this up. It's going to take a lot longer with this if you're trading other stuff. But the SPX 5 days a week now, it's just great stuff. So anyway, $60. We're trying to make that every day. We're stacking until we see another $500, dumping that into our trading. Now we're at $2,000 that we could trade with. We're making $80 a day. Once we stack that up, another $500. Now we're at $2,500 a day. This is going to be around day 54. Okay, day 50, trading day 54. All right, so this is about a little over 2 months, maybe 2.5 months, something like that. You should be here 2.5 successful months. You should be at about $2,500, starting from $500. Okay, starting from $500. All right. Now we're still trading with a large percentage of our total that we have. So we don't like that, but we're going to start changing that here pretty soon. Now, once we get up to about $2,500, once we get there, once you're up to the point where you're making about $100 to $120 a day, I think I cut this one off at $120 a day. Once you get about $3,000 and are able to trade with about 6 contracts, what I want you to do is start taking money out when you're successful. Okay, so here we're starting to take 20% of our profits and we're going to sock them away. We're going to put them in a savings account. We're going to take them out of the market. So in this case, $36, I made $120 here. I'm going to take 36 of those dollars and I'm going to sock it away. I'm taking it away. Okay. 20%. Okay. Take it out and don't let it come back. Just take it out, put it in a savings account, forget you have it, whatever. All right. And we're going to do that every day. Every day. Made $120, take out 36. Now I've got $96 saved up off to the side. Right. And we're just going to keep doing that. We're going to keep doing that. We're going to still let our excess profit build up until we get another $500. All right. And then we're going to add that $500 to our trading account. We're going to keep taking 20% out, 20% out, 20% out every day. All right. You see our savings account finally starting to kick in. And what's happening? What's happening while we're saving? Our at-risk percent of the percent of money that we have at risk overall is finally starting to cool off. It's starting to drop, right? We're in the 70s now where we were in the 80s, okay? So we're just going to keep doing this same strategy. Every time the excess trading account gets up to $500, we're going to add it. We're up to $4,000 now. We're about 67 days in. We're up to about $4,000, okay? Daily, we're making $160 daily now. Taking out our 20% every day. Every time we get up the excess account to $500, we're adding that to our trading account. And we're going to do that until we hit another milestone, right? And then this is all arbitrary. So you can play with this however you want. You can start saving more early. You can start saving less early. I just did this based on my experience, where I think once I get up to a couple $1,000s, I want to start taking a little bit of money out of the market and set it off to the side. You might have a higher threshold, a lower threshold, whatever. I do recommend that you check your greed. Check your greed, because everybody, once they start seeing these types of dollars roll in, they just want to grow faster and faster and faster, and that is the trap. That is a trap. Listen to me, that is a trap. You don't want to put a whole bunch of your money at risk thinking, oh, if I just risk, I've got 5,000, but I could put another 7,000 in there and then I can grow even faster. No, 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 don't do it. Do not. Okay? Don't do it. Save money off to the side. Think of rainy day. Think all this money could be gone in 1 second at one time off of a fluke accident, whatever. Save money off to the side. Okay? Don't have all of your money at risk if you can help it, especially once you get to the 5 figures. Okay? So you can see here, once I got to about $12,500 on this particular plan, I amped up all the way to 50% profit savings. 50% profit savings. That means save half, use half. Save half, use half. Okay? So now you can see the savings is really going to start ramped up. I'm starting my savings here at about $4,000. Now I'm going to stock away 50%. I'm making, how much am I making per day? $456 at this point. $456 per day. Okay, I'm sorry, excuse me, $500 per day, excuse me. $500 per day, okay? $500 per day is a really, really good income. That is a really good income. This is also why you should not be greedy, because you don't want to lose that income. You want to be conservative. Okay, most people in America do not make $500 a day. All right, $500 a day, income wise. If you look at 220 trading days, $500 times 220, that's $110,000 income per year. Okay, that is a good income. So you want to protect it. You want to protect it. I think that's why I started the 50% here. I probably actually would have started it earlier, which I can do. Whatever, you can make your own plan. But $500 a day is a really good income, and you want to protect it. If something happens, you want to get that income back, right? The only way you're going to get that income back is to put more money back into the market. That's why you have to save it while you're able to make it. So I'm taking $250 of that and I'm putting it towards my savings account, driving down my at-risk percentage, driving that down, okay? So we keep doing the same thing. Excess profit, every time the excess profit comes in, we're adding it to our trading money. That's where our growth is coming from. But that growth is going to start slowing down because we're saving a lot more now. So we're going from 20% to 50%. Maybe you go from 20% to 30% or whatever, 40%. That's up to you. But I want to save as much as possible, so when something happens, I'm able to bounce back very, very quickly, right? I'm able to bounce back very, very quickly. I've got all of this excess over here that if I need to roll, if I need to double down or do something or get out of trouble, I'm able to do that because I have money. Cash is king. Okay, cash is king. If you have all of your money at risk and you get in trouble, then you're just sitting there looking crazy. Okay, but sometimes if you have cash, you can get out of that trouble. All right, but anyway, so we're steadily growing our excess profit again. Excess profit is growing until we get to about $500, right? And every time we get $500, I'm taking 250 out until we get to a critical mass, right? In this particular plan, it's around $500, but we start picking up again once I get to about here. Now, we've been trading at this 50%, taking that 50% profit out for a long time, okay? So by the time I grow my trading account again, I've saved up $28,000 by this time, right? This is about 147 trading days. This is a good place to be. 25 contracts a day, $500 a day. If you can maintain that, you're hitting pretty good. You're hitting pretty good, right? Um, so this is the important thing: is the savings, is the taking out of the market, extracting money from the market, taking it out of risk and putting it into the pocket. That's the important thing. That's what we're here for, right? Um, so you once you get enough, you can start growing your trading money again, and that's going to set you off right back into the growth mode. So we got our first $500 pull here. We probably could have done it earlier, but the math and the sheet didn't want to. So now we're at 13,000 that we're trading with. We're making 520 a day. We're starting to grow. Look at this. Our at risk is down to the 20s. We were at the 80s. Look, 70s, 70, 80%. Now we're in the 20s. Okay? We want to drive that number down. Now, we get to a certain point, and then 50% is not even going to be enough. Okay? So for me, that point was right here when I had about 15,000. Now, the reason I went up here is because of these contracts. You don't want to be trading too many contracts and you don't have a lot of money backed up, because 20, 25, 30 contracts when it comes to options is a lot. There's a lot of contracts, okay? It starts to get silly. You start to run into problems if you start to trade too many contracts. It's harder to get fills. The exchanges start to do funny stuff with your orders. So you don't want to be trading with too many contracts. You want to remember that, okay? Keep your contracts relatively low. And by low, I mean like less than like 50 if you can. Less than 100 depending. I mean, if you're trading with like, I don't know, millions of dollars, you still want to be like 100 contracts or less. Widen your spread or something. Don't trade with like a whole bunch of contracts. Okay? It's a headache, all right? Um, but anyway, we start to get up there on the contract size in the 30s. So I was like, okay, so we need to start socking away more savings, right? More savings. That's going to keep my contracts down. I'm still opening myself up to growth, trading growth, but the priority here is to sock away more savings. All right. So I'm at 55%, still driving down my at risk profit every month, still driving that number down, still socking away savings. And see, at this point, when I'm here and I've got like 30 some $1,000, remember this is off of $500. We started with $500. Okay, so this is house money. This is all house money, right? This is money that you stole from the market, that you snatched right from the bear's mouth, right from the bull's mouth. Okay, you want to keep that. You want to keep that because giving this back to the market does not feel good. This is the reason why we're growing slowly, right? So that you can keep this, okay? You can keep these numbers right here and have them in your pocket and have them do some actual good in your life, to pay off some debt, to do whatever, right? To have some power, right? So we want to keep this, okay? So right now we're trading with 15.5, got 37 in the bank, making $600 a day, $620 a day. That's pretty good. That's really good. You can start to do some things with this, but wait, we're not doing anything with it yet. We're still stacking. We are still stacking. Okay. But we're starting to slug more and more away. By the time we get to 60% right here, we're trading with about 19,000, making $760 a day, trading with 38 contracts, still doable, still very doable. But it starts to get harder to find fills. Starts to get harder to find fills around these, 30, 40 contract numbers. It's getting harder to get filled. Um, but that's why you're trading the SPX. You're trading the SPX because it's the largest options market in the world. They got plenty of contracts out there for you, but it does start to get harder to find those fills, especially those instant fills that you're used to when you're trading 5, 10 contracts, right? They start to break up your fills. It's like, we got 15, 13, 3, 12 filled, stuff like that. It's annoying, right? But anyway, you're trying to make $760 every day, trying to make that every day. We're socking away 60% at that point. By now, by now, we have grown our savings account to $51,000 by that point. Okay. Now we got some real money. Okay. Now we got some real money. We started from $500 and we socked away safely $50,000. Okay. $50,000. That's what I like to see. That's what I like to see. We're only risking about 26%, which is still high, which means we're still climbing, right? We're still climbing. At this point, we're about 194 trading days in. About 194 trading days in. That's almost a full year at this point. Okay. So we keep on going, keep on going. We bump it up again, 65%. Right around 21,000 trading money. We got about 64,000 saved away. We're trading 43 contracts at this point, starting to get hefty, starting to get unwieldy, but it is doable, starting to get tough. So we might have to make some adjustments to our spread size or whatever. And it gets a little bit less efficient with wider spreads as far as your profitability. But it's much easier to trade wider spreads than trade a whole bunch of contracts. But we're making 800 some dollars a day, definitely worth the headache. Like Drake said, more money, more problems. Bring on the problems. Bring on the problems. Right? $860 a day. Bring them problems. Okay. So we keep on going. We keep going. We're socking away 65% of our daily profits till we hit another milestone, 70%, 21.5, still trading with 43 contracts. That's a nice clip. Nothing wrong with staying in the 40s. Nothing wrong with staying 43 contracts, right? Till we hit a huge milestone. Till we have $100,000. $100,000 saved away safely that we've extracted from the market based on our first $500. We're only trading 43 contracts, making 800 some dollars a day, living a life at this point. I mean, what can you not do when you're making $800 a day? You're only risking $21,000. You're only risking $21,000. You have six figures cash money that you could use to invest like old fashioned invest. You can buy a dividend portfolio if you want to. You can buy bonds since interest rates are up and get you a little bit of percent there. I mean, you can do a lot, right? You could do a lot. You can shrink this number down if you want to. You can shrink this number down if you want to. Live off less than $860 a day. Keep your 100. I mean, you have options at this point. You're only using 17% of your money. You got 122,000 total. You've got options at this point, okay, that you can do. What I don't want you to do is take this piece of this $100,000 and throw it into options trading. No, 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 no. You keep it below these numbers. This number or safer, okay? This number or safer. This number or safer. All right. You're not going to do more. Okay. You're not going to say, dang, I really like that Ferrari. Let me go ahead and do a one time trade, $50,000 of this safe money right here. No, no. You are patient. You've gone this far. This is more than a year at this point. A trading year is 220 days approximately, right? You've done this for a whole year, probably longer because I know you've had setbacks by this point. But you don't risk the safe money. It's safe money, right? So you don't do that. The most that you're going to do is covered calls with this money, okay? Because this has changed your life money. All right. Anyway, you keep going. You keep going if you want to. You keep going. Get your 43 contracts holding strong for you. 43 contracts. We're not going to go any more aggressive, but look at our at risk number. Boom, 10%. Now we're at that magic 10%. You're almost at $200,000. $200,000. If you blow up $21,000, it's okay. It's okay. That's all right. We'll live. Right. You don't want to do it twice. You don't want to do it. Keep doing it. But this is a one up. This is an extra life, couple extra lives right here. All right. But that's why I'm always saying reduce your risk. Reduce your risk. When you have cash, you can reduce your risk a lot. Right. You can afford to even do 2% a day. Maybe you could do the trade. I mean, you can make as little as 5 cents on a contract, which is almost idiotic. It's hard to use the word safe with options, but conservative. I mean, that's the last stop on the bus. That's the last stop is 5 cents. So at 5 cents, nobody's even going to pay you for an options contract. So you can take the last stop because you could do 40 contracts at 5 cents. And that's a good income right there, right? That's more than a lot of people make at their regular jobs. Or 10 cents or whatever. You can wait to the last, I don't know, 30 minutes of the day and do a 5 or 10 cent. Well, I probably wouldn't do that. You can wait to the last half of the day and do like a 5 or 10 cent trade. And that should get you far enough away from the market where, it's still pretty conservative. Um, or you could do it right at the beginning of the day and get maybe like 100 points away. Who knows? I don't know. It depends on volatility. But you could do extra conservative trades that way, and you don't have those same worries as you did when you only had $500, right? Where you had to get a little bit closer to the market just to make any kind of money and get somewhere. But this is where you're trying to get, man, and you can just keep going. There's no reason that you have to stop unless you want to, right? You don't have to stop. I mean, these numbers get stupid, and this is on the conservative side, right? 4% profit target per day, right? In 2 years, I mean, your life is completely different. If you were lucky enough to escape the top part, relatively unscathed, or able to restart when you did get scathed, I guess. Um, Here we are. Here we are after 2 years of doing that, right? Maybe this is 3 years. Maybe this is 4 years. Maybe it's five. Okay, maybe it takes you five. You get a couple of setbacks in here, a couple of rolls, a couple of days you didn't trade, whatever. The important thing is you saved. You saved when you won, and you saved, and that's what this leads to, right? This is the conservative plan. Let me show you the aggressive plan. Okay, instead of making $20 a day, I'm gonna show you the difference between making $20 a day and making $30 a day, right? Here's the 30. Here's the 30. Did I mess up that? Let me see. I just messed up the first number. Let me just change that. Okay, there we go. All right. So this is the aggressive plan, right? $30 a day instead of $20 a day. 6% profit. Same deal. Same deal. but we're just gonna come down. I'm gonna say 220 days after the first year. Um, I mean, we're trading with look, we're trading with 24,000, making $1,400 a day, just because it grew, so fast. I couldn't really. I just let it grow a little bit more. We're socking away 85% at that point. We're already at $200,000 in year number one, right? 220 days. Okay. Um, we're already down to 10% at risk, and we've got further to go as far as total money at risk, right? How long did it take us to get to 200,000 saved on the conservative plan? Let's see. Took us right there about 374 days, right? 371 actually. So 223 days. Where do we end up after 2 years? We just keep going. I mean, there you are. There you are, double, right? Um, and like I said, it's up to you how you want to or where you want to increase your savings, how many contracts that you want to get up to, all that kind of stuff. But this is showing you the possibility, mathematically speaking, that why you don't have to be nuts when it comes to options. You don't have to be aggressive when it comes to options trading. You don't have to make thousands of dollars a day or start with thousands of dollars when it comes to options, especially if you do it conservative, especially if you do stick with, vertical spreads. And I know that there's butterflies, things of that nature. I personally, I like credit spreads, um, put spreads, call spreads, condors, right? And not condors that you put on all at the same time. I'm talking about condors that you build. The condors, they're only condors because they call a put spread and a call spread that. But not putting on the condor for sake of putting on a condor. It just happens to turn out to be a condor. But credit spreads, simple, simple, conservative. They could be as conservative as you want them to be. Um, they're not perfect, but they're as simple as you can get. You once you get credit spreads, you don't have to think. Like, you just know what your number is, you know what your strike price is. You could just set it on almost autopilot, right? Set your alarm, go on about your day as far as work, because if you're only starting out with $500, you're probably working, right? Or have other things to do. So it's something that you can set it. It's simple. It turns into muscle memory. There's not a lot of thought behind it, right? Um, and it's defined. Like, you you know what you have at risk. You know that you can stop risking so much. You can risk exactly what you need to risk and still have massive, massive results over time. It gives you that snowball effect, access to that snowball effect that you need to build wealth. Um, if you look at any wealthy person that started from nothing, they follow the same hockey stick trajectory that this gives you, right? Start off very small for a very long time, building foundation, and then all of a sudden it turns on, and then their life is never the same again. This is like that. If you plot this to a graph, it looks like a hockey stick. Okay, so credit spreads, I like them. I like them because they're conservative. I like them because they're easy. I like them because they can be market neutral. I like them because you can be wrong, um, and you don't have to. They don't take a lot of brain power to do every day. You just put it on. You look at the market. You analyze the market. You put on where you think the market isn't going to go, and then you set it and forget it, and set your alerts. And if you get into trouble, you pull it off and then you try again, right? And you can start from such meager low amounts of money. The lowest, this is the lowest as far as the SPX, this is the least that you can do with the SPX is $500, right? You can start with $500 and within a couple of years turn your whole life around. Okay. And I'm talking like this, I'm not speaking from a place of like mathematically on a spreadsheet you could do this. I've seen it. I've seen obscene amounts of money being made from very, very modest amounts of money. I've done it myself, right? Um, so you don't have to go out there and get massive amounts of money or save forever before you can even start this. Just go out there with $500, get your experience up. You're gonna lose sometimes. Once you get comfortable with that, once you get comfortable with the fact that it is okay to lose, it's just not okay to lose big. Um, then you'll build up what you need to be able to do this consistently. Once you can get rid of the directionality in your head that the market, I can only trade thinking that the market is going to go up. I can only make money when the market goes up. When you get that out of your head and you understand it doesn't matter which way the market goes as long as you're on the right side of it, um, then that unlocks a lot of things and you can do this consistently, right? So that's what I wanted to share with you guys. I hope you learned something from it. Hope you like it. Merry Christmas. Hope you got some good gifts. See you later.